Hey everybody, this is going to be a topic of conversation revolving around mergers and acquisitions. It may take a half an hour or an hour or so, and the idea is to talk through some of the opportunities and some of the history and guidelines that have driven the M&A activity worldwide in the past 15 or 20 years. We've had a lot of discussions and we've covered recently a couple of cases on M&A, and we're going to do one or two more towards the end of the semester. So I thought I would kind of talk through some of the key aspects of mergers and acquisitions. So one thing that I think everyone should note is that mergers and acquisitions started to decline in the late 2008, 2009, not surprisingly, due to the recession, and in 2011 made a pretty substantial comeback. In fact, 2011 was a great year for M&A activity. 2012 not so much. 2013 we'll just have to kind of wait and see. One of the reasons why M&A activity has been, make sure the recording. Okay, I think we're good. One of the reasons that M&A activity has been strong, at least in the past year and a half or so, has been because valuations have been fair. So in 2008, 2009, valuations were low, PE ratios were low, and so you had a lot of firms that wanted to buy companies, but not a lot of companies that wanted to sell. And now we sort of have a little bit of the opposite problem, because valuations are much higher than they were before. So there are more sellers, so to speak. It's like the housing market. When prices of houses rise, you get a lot more sellers and you get fewer buyers. And so there are some sort of new trends that are occurring that we'll talk about. Also, the availability of cash has sort of come back. Sort of financing sort of dried up in 2009, but banks are more willing to finance acquisitions. If we take a look at the types of merger and acquisition activity that have occurred over time, this is around the last 20 years, we can see sort of an increase in, well, this isn't a time series, but this particular study is probably the most widely cited study, because if you take a look at the N, there were hundreds of thousands of observations included in this study, so it's been many more than has been in previous studies. And you can see if acquisition of assets tends to be the most prominent mechanism employed in M&A activity, much more so than mergers, for example, or acquiring minority interests in a firm. And so when people talk about M&A activity, acquisitions is the primary component for a change in corporate control. There's a lot more stats in here, but we'll cover them in detail in a couple of minutes. So in class on Thursday, we talked a little bit, as well as a few days ago, talked a lot about the method of consideration. And so notice also that if we take a look at the percentage of deals with a public target, it tends to be fairly low, which means that most M&A activity involves smaller private companies. In addition, notice that most of the deals, the consideration is primarily cash, both domestic and foreign. Cross-border deals, again, this is not a time series, but one of the things that we'll see is cross-border deals have increased in commonality over the past 20 years. Also, deals that involve the government have increased quite a bit, and we'll talk about that in a few minutes. Here's where we want to kind of take a look at deal activity over time. And what I think I want people to notice most is that M&A activity tends to occur in waves. So you have waves of less activity, more activity, less activity, and so on. And notice almost each of these time periods is sort of 3 to 5 years. And the reasons that M&A activity tends to occur in waves has to do with a couple of main themes: valuation and financing. And for valuation, you need valuations to be fair. That is, you want markets overall, PE ratios, to be somewhere around the middle of the road. Middle of the road averages around 15 times earnings for the S&P 500. If you get PE ratios that are earnings, then that means that that typical company is very expensive. If you get PE ratios of 10 times earnings, it means that companies are going to be really cheap. And when companies are either really expensive or really cheap, there's an imbalance of supply and demand for firms that are for sale. And so middle of the road is going to involve, is going to lead to more activity. And when firms are either expensive or cheap, that's going to lead to less activity. Of course, that talks about the availability of firms that are for sale, and there also has to be financing for the deals. Most companies can't afford firms for cash. At least, I know in the prior slide it said that many deals, the method of consideration is cash, but that's backed by lending activity. In other words, the company's got the cash by borrowing, as opposed to issuing shares of stock or stock swaps. This slide is fairly telling. It's a very busy slide, and so the key here is you want to understand what a CAR is. CARs occur in a lot of these columns. CARs refer to cumulative average returns. And so think about that as performance. And so if you take a look, for example, at the acquirer returns versus the target returns, what do you notice? That acquirer returns tend to be low and target returns tend to be high. So most of the returns related to M&A activity accrue to the target firm. And so, it might depend a little bit based upon the consideration. The other thing that you want to note is that post-acquisition or post-merger, that nearly half of the returns post-merger are negative. And remember, that's not acquirer or target because the firms are now combined. And so it means that the summary of this slide would be that acquirers' returns tend to be low, targets tend to be high, and post-merger returns tend to be fairly low and negative in many instances. We talked a little bit about how expensive M&A activity can be. This slide talks about the average premium that's paid. And so if you think about what a 0% premium would be. And this is primarily for this is for public companies. You get a company whose stock price is traded at $30 a share. If somebody comes along and pays $30 a share, that equates to a premium of 0. If somebody comes along and pays a 30% premium, then the transaction will have gone off at $39. 40% premium gone off at $42 if my math is right. And so you can see that the average premium ranges between, call it 30 and 40%. So a public company trading at $30 will have somebody come and offer between $40, $42 per share for the firm. So this is one of the reasons, going back to this slide, that acquirer returns tend to be low, because they overpay or they pay very heavily for target firms. And here's a slide that kind of speaks to those merger waves where we see fair or so valuations being around 15 or less, and in some instances, I don't know why that changed to that, but that's okay. The PE ratios tend to be very high, and that's, remember, there's a couple things going on here. This is the average PE offered in M&A transactions. It may not necessarily constitute deals. Now, in a prior slide, I said a typical PE ratio might be around 15, and in a low market, it might be around 10. But combine the information that the average premium offered is 30 to 40%. So if the market is trading at a PE ratio of 15 times, and somebody comes along and offers a 30 to 40% premium for a firm that's trading at 15 times, and that means that the offered PE ratio is going to be somewhere around 20. And so that's why these PE ratios look a little bit fat and rich compared with some of the prior statistics. Offered PE ratios are, you can see, average over 15 over time. Some recent trends, and these are put together from a lot of kind of homework that I did and some of my own background and knowledge in this area. One is, may seem a little bit different, but there's been an increase in the volume of emerging markets acquirers as opposed to just targets. Also, foreign governments have become investors, and they've become investors in a couple of different ways. And then number 3, there's been a considerable amount of growth in special purpose acquisition corporations. So these are sort of shell companies that are formed specifically for the purposes of acquiring other firms. And think of them sort of like a quasi-substitute for private equity companies. What I wanted to do was give you sort of an example of how governments have become involved, not just in the acquisition activity, but also in the regulatory activity, and what governments are saying that firms can and can't do. This is not necessarily the European Union telling Microsoft that it can't do something. This doesn't really have to do, even though part of this article talks about monopoly rules and anti-monopoly rules, these tend not to be as large transactions as what we would normally determine to be something that would cause a Herfindahl index or the concentration of market share to exceed a monopoly status. In other words, governments are getting involved earlier and more often. So one of the things that I wanted to bring up has to do with governance and mergers and acquisitions, that in the 80s and 90s, the pendulum sort of swung to the side of the executives large investment banks and shareholder wealth and power. And what occurred subsequent to the late 1990s was sort of an environment, not surprisingly, if you have a lot of wealth and power concentrated among a small number of players, you're going to get a lot more fraud and failures and greed. And what happens beyond that is that there's an environment of unfairness that then leads to regulation. And so we've seen in the past 10 years a number of significant regulatory advances that have been promoted, and some of them have been passed. And so the three that are probably most prominent are regulation, fair disclosure, Sarbanes-Oxley, and the Dodd-Frank Act, which is a little bit more recent. So Reg FD says that basically companies have to release information to all investors at the same time so that large investors don't get a leg up on smaller investor. Sarbanes-Oxley, we know, sort of came about, this is like the post-Enron era, and so we talked about Enron already before spring break, which we generally don't want accounting firms providing non-auditing work at the same time. So public accounting firms shouldn't be doing consulting work with the same companies that they're supposed to be auditing. We've also got some oversight through a board, as well as some additional components of corporate responsibility and disclosure and controls, as well as different penalties for fraud. Again, a lot of these rules came about after the Arthur Andersen Enron debacle. So that's Reg FD and Sarbanes-Oxley. And in the Dodd-Frank Act, there's a very, very long set of regulations, but our focus is in the area of corporate governance. And what I would say is this is primarily around the role that executives play and making sure that there's dispersion of power and controls at the executive, in the executive levels of a corporation. So one of the things that we have to be careful about is kind of understanding perverse incentives when we talk about merger and acquisition activity. And so one of the things that we see is if we want to think about what drives M&A activity, sometimes it's driven by efficient, effective mechanisms like economies of scale and acquisition by growth, or taking advantage of tax rules or things that make economic sense. And sometimes they're driven by things that may not make as much sense, such as hubris, people wanting more because they like bigger and better things. People wanting more because they want to be paid more, not necessarily because they think they can create value. So that's what we're going to explore in a little bit. So some of the key motivations and determinants of mergers, these are not surprising, but just to kind of get them out there. Growth by acquisition as opposed to organic growth, synergies, diversification, and these are not mutually exclusive, that we might be able to improve the management of the target firm by buying it. Hubris. Hubris just refers to sort of getting emotionally attached, and hubris means sort of excess pride, if you will. Vertical integration, financial synergies, horizontal mergers, pursuit of power over suppliers and buyers, tax benefits, and then some other ones more recently have included access to otherwise closed markets. And so if you think about these reasons for M&A activity, that some of these make more sense than others. So growth, synergy, improving firm, integration, another synergy, some tax benefits, access to markets. Those are sort of positive motivations for mergers. Diversification, we'll see, has not been that positive. Hubris is not a great motivation. In other words, it doesn't tend to work real well. Here's an example of J&J's acquisition strategy in the past 15 to 20 years. Notice that most of the acquisitions are around pharmaceutical, biotech, and some consumer product. There are a couple of sort of serial acquirers that we're going to talk about. J&J is one, GE is another, Cisco is yet a third. Synergies we've discussed in this class quite a bit, so I'm not going to spend too much time on that. We've already discussed how cost-reducing synergies tend to be fairly easy compared with revenue-enhancing synergies. And we've talked also a lot about what synergy means in terms of improving value. The theory is 2 plus 2 equals 5, but in practice, we know that most synergy happens from simple things like eliminating duplicate facilities and reducing costs that are spent in specific areas. Exxonmobil is an example of a merger that occurred that had cost savings that far exceeded what the expectations were, and 20% is a pretty big increase in what the cost savings were. We're talking about $1 billion, and one of the reasons is because there was more duplication than expected, and they could get some greater gains from technology related to oil extraction. But notice where most of the synergy came from, job cuts. So we have to be careful about how we think about value creation. It's value creation primarily for shareholders at extracting value from employees, for example, or another source. Diversification doesn't tend to be a great method of creating value. If I'm good at managing one type of business, I'm likely not going to be able to duplicate that to some other areas. There are some exceptions, and GE is one. Again, Cisco is another. And these are firms that have a proven process for going through an acquisition strategy. Some other ones, Microsoft tends to do a pretty good job. Berkshire Hathaway, which is more like a holding company, they do a pretty good job, although recently not as much. Beatrice is a firm that came about in the 1980s. Beatrice just was a collection of companies. You don't know them today because they had to disband because they did not do a good job. So some research on diversification and firm value, and a lot of this is old, and the reason why it's old is because companies don't tend to do it anymore. And the 1980s was sort of the heyday of companies diversifying because they thought it created value, and so a bunch of studies that came out in the early 1990s said no, that's not true. That diversified firms, in fact, lose between 13 and 15% of firm value, and firms that increase focus do a better job at creating value. But more recent studies have looked at the specific types of diversification, related versus unrelated, and what we found is that related diversification is much better at creating value than unrelated diversification, which makes perfect sense. And there have been, again, more recent studies that have looked at the types of relatedness, vertical, horizontal, and what the overall punchline here is that vertically related firms. So acquiring firms that are up and down the supply chain, for example, don't do as well as firms that are complements. So an example of complements might be, I don't know, a brokerage firm and a bank um, combining, or a brokerage firm and a firm that focuses on high net worth clients, for example. Those are complementary firms. If we think about desirable characteristics of targets, so if we're thinking about buying a company or a part of a company, what types of characteristics would make the target desirable? A low PE ratio, for example. That means that they're cheap. High book value means that they might have some set of tangible assets. Firms with undervalued assets, firms with liquidity, steady cash flows. These are fairly common sense. Unused or underutilized borrowing capacity. No regulatory issues. Firms that do not have a concentrated block of stock in the hands of insiders. In other words, it might be easier to get control of a firm. Management that would be amenable or friendly to a takeover. And then finally, not that it happens often, but an overfunded pension plan, which you could extract some value out of. There are other types of, when we talk about merger and acquisition activity, there are other types of corporate control mechanisms, and one of them is strategic alliances. So that's sort of a not quite acquisition, right? So we have a strategic alliance that is two companies that may in fact be competitors. So think, Google or Microsoft and Yahoo, for example, right? They might be competitors in some realms, and they'll create strategic alliances so that they can compete better against Google. So strategic alliances tend to do a good job at creating value, depending upon the type of alliance. So the type of alliance, for example, that involves the transfer of technology tends to do better than other things, and alliances that allow firms to enter a new market showed, it says, the lowest returns, but even these returns are much better than other types of M&A activity. So low for alliances, but high compared to other M&A activity. Let's see. I guess one of the things that we, when we think harder about that cumulative abnormal return, we also have to be careful that when we're measuring these, that the cumulative abnormal return tends to occur at this point right here. In other words, an acquisition is announced, and we want to measure the change in a return from this point to some number of days beyond that point. So the cumulative abnormal return in a lot of the statistics might be 2 to 3% from the acquisition announcement to the time horizon afterwards. In other words, this is how much money I gained, or how much value that is estimated to be created for the shareholders. But if you look, there tends to be a run-up in announcements of companies. And so there's that component to think of as well. And this is where information transmission occurs. And people trade on the rumor before the fact. When we've seen the next couple slides before, the type of synergy that are used to create value, it's worth perhaps talking through again where synergy is created. Again, a lot of it has to do with specific operating synergies and improvements in cost structure. But this is a slide out of a paper by the motor in, it can come from a number of different areas. So from taxes to cash slack, in other words, that we can achieve greater synergies if we're together because we might have more borrowing capacity, for example. We've seen this slide before. It just says that if we have cost synergies, those are easier to achieve. In most cases, revenue, not as much. The last set of slides talks about financing. We've kind of moved into the course into a discussion about the terms of agreements and when equity versus cash may matter. And so if you take a look over the past 10, 15, 20 years of the proportion of deals where cash is used, that cash is used much more prevalently these days than it was 20 years ago. And part of the reason has to do with the fact that many companies that are acquirers have a lot of cash. Another reason is because this isn't really cash, it's just cash that's financed with debt. In other words, debt is backing. I've borrowed money, that gives me cash, I'm using the cash for an acquisition. Okay, so it's a cash deal, but it's from borrowed funds. So a couple of things that I want to talk about is cash, role of private equity, role of hedge funds, and then the junk bond market, which is essentially the market used to finance M&A activity. Okay, so one thing that we've seen in the past 10 years is the relative increased role of private equity firms. And they are sort of similar to hedge funds, but they exist just to make equity investments in firms. And we know that they achieve what do private equity companies do, right? They take pools of cash from money that they raise from high net worth investors. They use their own cash from their partners and employees of the firm. And they take that cash and they invest in a series of companies over time. And they can't just buy the companies with that cash. They usually need to borrow a sum of money. So they tend to be very levered transactions. And the private equity company comes in and they take a company private and they improve the company and then they take the company public. So they provide some management expertise, they provide capital, they try to create a more efficient firm, and then they unwind the transaction over 5 to 7 years. One thing of note, private equity companies used to be, so if you think about private equity companies versus hedge funds are normally thought of as companies that do sort of the same thing, at least the type that invest in firms, as opposed to currencies or commodities or things like that. Hedge funds normally or historically have been thought of as speculative and short-term players in the market, whereas private equity firms have been thought of as longer-term players in the market. And that division is blurring now. Private equity firms are becoming more short-term oriented, and hedge funds are becoming longer-term oriented. Private equity, you can see, has increased as a proportion of all M&A activity as well in the past 30 years. Here's an example of a very, very large private equity fund. Many funds are in the millions or tens or hundreds of millions, and the bigger ones tend to be in the billions. And this Carlyle Group's $10 billion fund was the largest one at the time. And you can see why private equity has increased is because their returns have been fairly spectacular. Now these are private claims, as they don't really, unless they're public companies, which there are some more recently, you can't really observe what their returns are. The other thing that we see is investment banks creating their own private equity arms. One of the things that we're seeing now, we have investment banks, we have private equity firms, and we have hedge funds, and the lines between them are blurring. Investment banks have private equity arms and hedge fund arms. Private equity firms use investment banks to seek financing. So do hedge funds. And so if you think about it like this, if you're a private equity firm and you're a hedge fund and you traditionally seek financing with JP Morgan or Goldman Sachs, who now have their own private equity and hedge funds, private equity arms and hedge fund arms, that the investment banks who used to be your partners in financing are now also your competitors. So it's become an interesting time in this particular arena. And again, why does this happen? It happens because there have been opportunities in this area. And so there have been conflicts of between private equity firms and investment banks. We talked a little bit about hedge funds. They're starting to take larger, longer-term positions. They're relatively new entrants in the M&A business. They've taken an active governance role, created more pools of capital. They're organized a little bit differently than a typical hedge fund if they're interested in M&A activity, but they've done a pretty good job overall. Hedge funds, you can see, kind of in a declining period of hedge fund activity, but at their height, there were almost 10,000 hedge funds out there, which is as many mutual funds that are out there. Last topic of the day talks about financing. That underneath all this stuff, it's rare for private equity firms, hedge funds, and investment banks to employ solely cash to purchase another firm. That it's usually backed by bonds. And it's backed by debt financing. And as you can imagine, this is risky debt financing. And in the 1980s, this is called the junk bond market. And the junk bond market exploded in the late 1980s because of the perverse risk incentives. In other words, there's just too much risk, and banks were taking on too much risk, and there was a lot of intertwining junk bond activities. So when there was a recession in late 89, early 1990, there was a collapse of junk bonds that took some banks with it. Does that sound familiar? It sounds a lot like the real estate collapse causing banks to have problems in 2008, 2009. So what's changed since then is we still need risky debt, but the risky debt so we still have junk bonds. If you look at this chart, you can see the heyday of junk bonds prior to the collapse of junk bonds. But now look what's happened recently. Junk bonds have grown up again. But the leveraged loan market is very different now. The leveraged loan market is the key difference is that the bank financing doesn't stay on the bank's balance sheets. In other words, I will originate a junk bond if I'm a bank, but I will find buyers who are willing to take those bonds off of my hands. And so if I'm Citi, I might arrange for junk bond financing for a private equity firm, but I'm going to quickly sell those loans and get them off of my balance sheet. I'm not going to take them off of, and you can see that well, who's going to buy them? Well, a lot of times, other hedge funds buy them. And so you'll have some hedge funds taking an equity position in firms, other hedge funds taking a debt position in firms, and they might not be the same firms. Also, the buyers of these leveraged loans might try to securitize the income stream. In other words, if I'm investing in a firm and I'm investing, if I'm taking a company private and I'm using a lot of junk bond money to do that, what I might do to reduce the risk is take some of the safer parts of the firm that I'm buying and attach those directly to pay for the junk bond. So if I've got a risky company that has a financing arm that's fairly safe, I might attach the cash flows from that particular part of the company, and those cash flows are those are dedicated to paying off the loans. So I guess from here, that's sort of an overview of kind of the history of M&A, current trends in M&A, as well as M&A financing. We've covered a couple of M&A cases. Our next class is we're going to be covering a case that involves Timken, which is a smaller company, which is something I think a little bit maybe more near and dear to things that we're interested in. And so that's the goal for our next class session. So I hope you guys enjoy the rest of your time, and I'll see you in class.